Welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management. My co-host today is Eric Parnell, Chief Financial Analyst and Chief Marketing Strategist from Great Valley Advisor Group. Hello there, Eric.
Hello, Mike. How are you? It's great to see you today.
Yeah, you as well. So today we're just going to have a conversation between me and you, talking about markets, environment, things that are going on. But before we kick that off, I have a question here from a viewer that is Joyce Norman in Philadelphia, asking, how do you handle risk in investments?
That's a great question, Joyce. And, thinking about the work that we do here at Great Valley Advisor Group, we provide investment solutions for advisors who then provide it to their clients. So that's a question that we get a lot in terms of how do you handle risk when it comes to investments? And one of the things about risk, it's a double-edged sword. We take on risk in order to generate a higher return than what we would get in the savings account. And the key in terms of how to handle risk is incorporating it into an asset allocation that's diversified, because you want to own risk assets, but you own assets that are risky in combination with other risky assets that when you blend them together, they help neutralize that risk. So the construction of a portfolio and the proper asset allocation process is a key element in terms of managing risk and extracting the return that those risk assets can provide.
I like that, Eric. Yeah, it's people, when I wrote my book, Jackass Investing, Don't Do It, Profit From It, in 2011, and it was to sort of hit on different investment myths. And the final myth in the book is there is no free lunch, because you hear it all the time that there's no free lunch, but the reality is people kind of intuitively have known this, and then Harry Markowitz mathematically proved it back in the 1950s with modern portfolio theory and the fact that if you can diversify across multiple investments, even if they're all individually risky, if they're not all correlated with each other, you can actually reduce the risk and maintain that same higher level of return. So it's super important, I think, portfolio diversification and keeping things balanced in a portfolio so you're not overly dependent on one stock or one fund in the portfolio. So I think risk is something everybody needs to be looking at and taking into consideration. The other thing I've always noticed is that people are willing to accept risk until, as I guess, which is the famous boxer that said it, until they get punched in the face. Is that Mike Tyson?
Exactly.
Yeah. And then all of a sudden they realize, oh, maybe I wasn't willing to take on so much risk.
Yeah, it's amazing. People love risk when it's moving to the upside, but they have a different feeling about risk when it turns around and, all of a sudden they're taking the elevator down. But, in terms of the portfolio allocation process, one of the things that's important when monitoring the performance of an investment portfolio, you can have assets even for a conservative investor and an investor that really doesn't like a lot of volatility in their portfolio. You can have specific positions in a portfolio that are very risky. And sometimes you'll have clients who will look at that, or people will look at that and say, well, why do I want to own this? This is so risky. I don't want to take on this kind of risk. But if the asset allocation process, the portfolio modeling process is done right, there are times when adding a very risky asset to an investment portfolio can actually lower the risk of the overall portfolio, even though it may be very risky in its isolation. So when monitoring portfolio performance, it's important not to hone in necessarily on a single position, but understand the role of that specific position in the context of the overall asset allocation.
That's a great point, because I've had that over the years where we used to break out some of our hedge funds the attributes. Where did we make the money? Which strategies made money? Which markets made the money? And we would find clients then coming to us and saying, can you just give me that? One of the strategy market combinations in the portfolio, because it outperformed for some extended period of time. And we were constantly battling that. And we stopped giving that information out because people were trying to cherry pick based on the past performance, which you and I know, okay, but that's probably meaningless for what's going to happen in the next 5 years. It's not giving you a lot of information.
No, you're absolutely right. It's an understandable temptation for investors when they see really strong performance in a certain area of the market over a specific period of time. And the thought is like, wow, that was fantastic over the last 2 to 3 years. well, that must mean I want to own it because look at these great returns. But the important thing to remember about investing is that, you know, in stock market sectors are constantly going in and out of favor with one another. Growth and value are constantly going in and out of favor with one another. Different market asset classes, U.S. versus international, stocks versus bonds, are constantly moving in and out of favor with one another. And that's the importance of maintaining that long-term discipline and sticking to the plan, because you want to be able to allocate to those areas that are doing really well at a certain point in time, but you don't want to neglect being allocated to those areas of the market that are going to do well over the next period of time.
Yeah, I just spoke with someone yesterday, a large investor, and the people I was talking about before, those are institutional investors making those decisions. So it's not that it's something that they're immune to because they're managing billions of dollars instead of millions or hundreds of dollars. But I talked to an investor yesterday who's a multi-million-dollar investor. He's a wealthy person. And he's in a fund that has been underperforming for the last decade. And he said, I'm getting ready now. I need to put my notice in to redeem it. It's a hedge fund. It's way under the S&P. And I said, well, what's the fund doing? It's got value focus. I said, well, that just explains it. The value stocks have just underperformed for the last decade. So he says, well, maybe I should actually be staying in or giving money to them. I said, look, I can't answer that question, but I do know that reactionary looking back and seeing them perform, getting out. That's what people did in 2000, because of value underperforming. For the next decade, that's where you want it to be.
No, absolutely, and you see it happen time and time again, and it's an industry-wide phenomenon. And you see it even at the institutional level. I think of emerging markets, for example, and emerging markets are fraught with a lot of different challenges, to be sure. But coming into 2024, there was all of these product managers that were creating these ex-China strategies because China had been performing so poorly for so long. We're going to take China out of the emerging market strategy. And no sooner do these strategies become widespread and everybody's allocating into them, that all of a sudden China's up like 20-25%.
Yeah, you did that in a week.
And you see it happen over and over and over again. So
yeah, absolutely. It's another thing I had written about in the first chapter, and that's that people, I think it was one of the first 3 chapters, but people will do the opposite of what they should do. And that's what makes the markets. And that's why when you look at studies like Dalbar and you see that they underperform the very funds into which they invest by as much as 5% a year consistently, year after year after year. And you'd have to look no further than something like ARC funds, which had just a phenomenal run in the late teens and went from some money under management to tens of billions, just in time for tens of billions to be evaporated as those stocks that they're investing in collapsed. And it's going to, I don't think that's going to end. It's human psychology.
No, it'll happen over and over and over again. You have those funds or those strategies that, they're top decile performers or they're top percentile performers. And the money will flow in because they see this fantastic performance. But one of the things that's so important to remember is that to become a top decile or top percentile performer in an investment strategy means you're taking on a lot of risk. And if you are being rewarded for that risk over one period of time, chances are you're going to be punished for that risk over a subsequent period of time. And you see that the analysis out there where a strategy that's in the top quartile or in the top decile over a 5-year historical period, more often than not ends up in the bottom half over the subsequent future 3-year period. Unfortunately, it's at the end of that 5-year period that all the investment dollars start showing up to get allocated just as the tide is about to turn.
Yeah, absolutely. I mean, there is some evidence of short-term year or two momentum in markets. I mean, it's one of the factors, that academics have discovered, trend followers discovered it centuries ago, but it's now sort of published and known. But I had just an individual investor ask me, it was a couple of decades ago, where should I put my money? And I said, whatever's been performing worse.
Exactly.
Essentially, and it's tougher to do that, but over time, being the contrarian, the value stocks will have their day again. These large cap growth stocks will not keep growing to the moon. There will be reversals in that.
Yeah, and it hits on an important point too about one of the things that has been on my radar screen for a while is the disproportionately large weighting to technology in the S&P 500, the information technology sector, as well as those tech adjacent stocks, those that used to be in technology that are now in communication services, or, those that used to be in technology that are now in financials, or, the tech adjacent stocks and consumer discretionary. But even if you focus on technology alone, it makes up over 31% of the S&P 500. And if you go back through market history, any time that a single sector in the S&P 500 has gotten over 20%, it's usually been a warning sign. You go back to the early 1980s and you had the energy sector that was over 20%. In the late 1990s, it was the technology sector that got as high as 36%. You had financials back in 2007 that got over 20%. And here we are today with technology over 30%. It's in dubious company. Not to say that maybe this time will be different, but there's an investment highway littered with people saying this time will be different. That's been pretty painful.
Yeah, absolutely. I mean, I remember the DuPont Conoco, a buyout in the early 1980s, and I mean everybody's wanted to be in energy, and that was a disastrous combination at that time.
Absolutely.
So right now, I mean, stock like NVIDIA, I mean, great. The company's doing great. I mean, they're printing money with huge margins, but that does attract competition. And in my mind, I'm just singling that out here for a second. I look at that and it reminds me a lot of the Ciscos and some of the companies in that last tech boom in the late 1900s, where you had a lot of the companies buying the technology, not making any money on it. Mm-hmm. And ultimately, they stop investing the capital into it if it's not producing a return. And I just don't see the big return coming from some of these AI initiatives in the hundreds of billions of dollars scale that they're investing right now to warrant that kind of continued buying. Right now, it's obviously it's just a land rush. People are going crazy, but that's where you see these peaks.
Yeah, I mean, talk about bringing future value forward to the present. I mean, the thing that I've always said is that bubbles happen for a reason. The dot-com bubble back in the late 1990s, the internet was going to transform the world, and it certainly has over the last 25 to 30 years. But it didn't happen all at once in the year 2000. Artificial intelligence, will it be transformative to the world? Probably, in terms of the capabilities and the way it can process information and the efficiencies it can deliver. But it's not going to all happen in 2024. It's a process that's going to take 20 to 25 years to play out. But the market is pricing it all in as though it's all going to just happen right now. And that's where the danger can come in terms of people chasing investment themes that may certainly manifest themselves over the next 10 to 15 years. But just like Cisco Systems was trading at a higher price in 2000 on a dividend adjusted basis than it is today, it'll be interesting to see where NVIDIA is trading 10, 20 years from now relative to where it's priced today, given its valuation, because it's priced in a lot of future growth as we sit here.
It has, and there, a lot of those stocks are at 50 to 100 PEs, and that's based on pretty aggressive E side of the equation as well. So it's that kind of leads into a question here. I sort of maybe say facetiously, but our first question with the user was about the viewer was about risk in the markets. Do you see any risk now? I mean, it seems like there's some stuff going on, but kind of boring, right? We got a presidential election. We got wars in the Middle East, monetary policy shifting. Anything going on that might affect the markets?
Yeah, it's other than that, there's nothing going on, right?
I thought, okay.
Yeah, it's one of the things that concerns me as we not necessarily as we go through the rest of 2024, because the market historically has a good track record in election years, and it historically has a good track record not only leading up to the election but in the weeks after an election, because you have a lot of fiscal and monetary stimulus, or fiscal stimulus in particular, coming into the market leading up to election day. And then a big uncertainty has been removed from the market in terms of who's going to control the executive branch, who's going to control the Senate, who's going to control the House. And with all the liquidity that's in the marketplace, the immediate term looks, fairly solid. But we have a Federal Reserve that stepped in here, and they didn't cut interest rates by 25 basis points like everybody was expecting, or most market participants were expecting up until maybe a few days before the Fed meeting. They went in for a half point interest rate cut. And that raises a bunch of questions. It says, well, what is the big concern that would cause them to raise or to cut interest rates by 50 basis points coming out of the gates in September, with an economy that's growing at 3% in terms of GDP growth, an unemployment rate that, yes, it has risen from 3.4% to 4.3% since April of 2023.
Still quite
But at
low.
4.3%, you're talking about a historically tight labor market, the lows in unemployment rates going back through most economic cycles, going all the way back to the late 1950s. One of the things that's generating is a fairly sharp steepening of the yield curve. And, I don't want to get, too deep into the weeds in terms of the technicalities, but basically what that means is that short-term interest rates, like the savings that you can get on your money market account or your savings account, whereas the Fed cut interest rates, that drops a lot. But long-term interest rates can hold fairly steady. And that difference, when short-term interest rates are dropping and long-term interest rates are holding steady, that's what's referred to as a steepening of the yield curve. And when you go back in time and take a look at instances going back over the last 50 to 75 years, when we've had a dramatic steepening of the yield curve, which is getting underway right now, in every single past instance, with the exception of one, U.S. stocks have ended up in a bear market, falling by an average of 28% over an 11-month period on average. Now, that may not happen this time around, but that is historical precedence. And for all of those people that were so enthusiastic to say, oh, we can't wait for the Federal Reserve to cut interest rates, all that liquidity is going to pour in. Well, typically when the Fed starts cutting interest rates, there's a negative market reaction historically before we get the positive market reaction. So it'll be interesting to see how that plays out.
Yeah, so I two questions with that. The one is, over what does it sounds like you kind of answered there maybe at the end. You get a negative reaction almost as soon as it steepens, and then you get positive. But also, we've been hearing for years, last couple of years, when the interest rates invert, when short-term rates rose above long-term rates, that was going to cause recession. That was a sign of recession, that a precursor. It was going to happen, and that never happened. Why didn't that happen? And why is there any time that's good for a market? You get inverted, it's bad. You get steepening, it's bad. It sounds like just keep me out.
Well, no, you're absolutely right. I mean, we've had this inversion, and it's a historically deep inversion, basically saying that, I can get paid over 5% lending money to the U.S. government for 3 months, but I'm only going to get paid like 4% for lending money to the U.S. government for 10 years. I mean, that's, that seems like upside down. What's going to be interesting to see is that in the past 13 instances, going back over the last 100 years, when we've had an inverted yield curve, we've had an economic recession. There's only one exception. It was 1998, but we eventually got it in 2000. We've had a recession, and we've had a bear market in stocks. Now, it's not when the yield curve inverts that we get the recession and the bear market in stocks. It's when the Federal Reserve starts cutting interest rates in anticipation of that recession arriving, where that bear market can arrive. Now, it'll be interesting to see how it plays out this time, because one of the things that's been an exception, talking about things being different this time, in 2022, you had the Federal Reserve raise interest rates by 5.5 percentage points in a very short period of time, basically 18 months. Historically, whenever the Fed's done that, we've had, an economic breakdown, and we've had a bear market, and that hasn't happened yet. I mean, we're looking at the potential for an economic soft landing, a labor market that's showing some softening, but not dramatic softening. Maybe they've solved the riddle this time after so many past experiences to reflect on.
Yeah, it's interesting you mentioned the 98 and then the recession in 2000, because I feel like this has so many similarities to that as far as speculative nature, some of these tech stocks again. And of course, now we've also got things like crypto and Bitcoin and real estate prices that have also skyrocketed over the last couple of years. Some of that's been moderating, so it seems like maybe we're getting some sort of a little bit of a shift in some of the real estate and some of the crypto. It's you don't quite have the NFT mania and stuff like that was going on. We don't have SPACs, they busted. So could it be that we're getting this sort of rolling financial markets recession that's not going to affect the economy as a whole?
Yeah, I mean that was what was interesting about the 2000 recession, because even it took the aftermath of 9/11 in 2001 before we finally saw the economy go into recession, and it was very mild. And you're right, there seems to be a lot of correlation between excess valuations. You look at the S&P 500; it's currently trading at 29 times as reported earnings or GAAP earnings, which is historically very expensive. But we still have an environment where fiscal liquidity is coming in, monetary policy liquidity is coming in, labor market's still tight. There's been talk of a potential, an expected recession going all the way back to the end of 2022. I mean, it's never arrived.
Yeah, right.
It's always getting pushed off into the distance. And there's a lot of reasons for optimism that, even if we do get an economic slowdown, even if we do get a recession, it's likely to be mild, because there's a lot of underlying strength here. I think the bigger risk, and it's one that I've been concerned about for a while, you still have lingering inflation pressures that are percolating underneath the surface of the economy. You don't see it in the headline inflation number or the core inflation number, but you look at services inflation, you look at what's taking place with home prices. I mean, home price inflation has been pretty solid despite high interest rates, and now interest rates are coming down. If we get a renewed surge in inflation like we saw in 2022, that puts the Fed in the box. So, we head towards a recession, we have rising inflation. I mean, that's got a 1970s vibe to it if that plays out.
Yeah, they've been fortunate, skillful, lucky, I don't know what you might call it, but that they had the ability of running up interest rates as sharply as they did, that helped kind of stop some of that inflationary pressure that came about from the Ukraine war, for example. I'm sorry, it's the Ukraine special military operation in Ukraine. And, things like that were going on that caused disruptions, COVID disruptions, supply chain. They were fortunate, I think, that they were able to raise rates like they did, and it had a financial market impact, but it really didn't, because of all the fiscal, largesse, it didn't really affect the economy that strongly. I don't see that they're going to get that same benefit or opportunity, now. If things start rolling over, I just don't see the fiscal floodgates opening the same way. Yeah. And if you have inflation on top of that, it might be worse than stagflation like we had in the 70s. It could be a bad environment.
Yeah, no, absolutely. Because that's the thing, we had all of the, as you said, we had all of those COVID dollars that were pouring into the economy in the aftermath of COVID that, so even if we had an economic slowdown, it was off of such a high level. Those support systems aren't in place. And if they do start to kick in place, what are those inflationary impacts, and does that put the Fed in the box? Or even worse, if inflation starts to rise as the economy slows, if history is any guide and the lessons they learned from the 70s, the Fed's going to turn and fight the inflation problem first, knowing that they can always come back and boost the economy. So it'll be interesting to see, one, if that scenario plays out, and two, how the Fed handles it, because that starts to become a tricky spot.
Right. They've been able to sort of thread the needle on their dual mandate, for the viewers know, which is inflation and employment. They've been able to knock inflation without killing employment, and as you pointed out, even though it's gone up to levels that are historically low unemployment levels. So that hasn't been a problem. So we've talked about a lot of different risks and things that are going on in the markets. Does it change how you would see people making investments? Do you skew something one way or another? Do they just put it in an index fund and let it ride and close your eyes and don't worry about it? What do you recommend at Great Valley?
No, I mean, I think it's a great question, Mike, and I think you nailed it on the head in what you said at the beginning of the show, is that we have had this prolonged period where the winning in the market, and the stock market in particular, has been so concentrated. It's been in technology, it's been in artificial intelligence, it's been in semiconductors. And there is a whole vast equity marketplace, and there is a whole vast capital markets marketplace where there's a tremendous amount of opportunity. And history has shown that even in more turbulent market periods, there's the opportunity not only for outperformance, but also solid gains in areas, more defensive areas like consumer staples and healthcare, in more traditionally cyclical areas that are showing attractive valuations like industrials and materials. There's think about mid caps and small caps trading at their deepest discounted valuations in over 30 years. So the propensity for a lot of investors has been to think, you know what, I'm just going to index and just let it ride. Well, the only problem is that if you index, and let's just say you go out and buy the S&P 500, you're buying about a 40% slug to technology, which is the area of the market that has done so well for so long, in an environment where, sector leadership shifts all the time. And so this may be an environment over the next 5 to 10 years where active management is rewarded in a way that it hasn't been for a long time. And it's not necessarily active management from a stock selection standpoint, but from an asset allocation standpoint, and recognizing all the different opportunities across the market.
Yeah, we actually just made a change in one of our hedge funds where it's got an initial position that was 1 or 2% in NVIDIA. It grew to 10%. And it shouldn't be at 10%, to keep in a balanced portfolio. So, we brought everything kind of back into balance in those portfolios with kind of the understanding of some of this conversation we're having here that, it's been a great performer, but when you're in an environment where these stocks are trading at 50 to 100 multiples, they've been in multi-year runs, and they make up now a third or more of the index. When 20% is already a high level, I think it really makes sense for people probably to don't think of it as market timing or even asset allocation, just rebalance.
Exactly.
Get the portfolios in balance. And that's what we talked about earlier. If you can keep a balanced, diversified portfolio, over the long term, you've got the best shot of really getting that free lunch.
Yeah, rebalancing, taking some money off the table and distributing across the rest of the marketplace, and adhering to that long-term discipline.
Oh, Eric, it's great. I appreciate it again. Once again, we could just keep going forever. Your fountain of knowledge and information, I truly appreciate it. It's fun having the show with you.
It's great being on with you, Mike. I enjoy it.
Thank you. Okay, and for the rest of you, first of all, if you want to send in your questions to Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
And our next guest on Money Matters TV is Tammy Freitas, CEO of ACT Capital Advisors. Thank you for watching Money Matters TV, where your money matters. See you next time.